Hey everyone, glad to be back. That was a quick one. Today we have fantastic panelists to talk about the hard choice between growing the yield, so going for the strategies that generate the highest return, and also the risk, because one and the other usually goes in pair. I'm Marcin, co-founder at RedStone, and also right now Credora, the DeFi risk ratings platform methodology. And I would like to start with a round of intros from our panelists. So maybe Carson, we start with you, so from the left to the right.
Hey everyone, I am Carson Brown, Senior Product Manager at Gauntlet, working across really all of our vault strategies.
Hi everyone, I'm DMH, I'm CEO at Fluid. Fluid is a liquidity protocol. We have a lending market, DEX, and many more things in the future.
Hello, I'm not Sam. I'm Nadia, co-founder of Spark and COO.
Beautiful. So I like opening the panel with an icebreaker. So here it comes. If you had $1 million in your pocket today, it can be $1 million of USDC to make it simple, on Ethereum. What is the attractive APY to put the money into a single strategy for a year? So what is the APY you would expect for 1 year?
I mean, easy. It could be 1 million, it could be 10 million, it could be 100K. I will use a Spark. And it's not because I'm biased, but because we take security seriously. So if I want to just like sleep and don't think about my money, I will use a Spark. But actually, our treasury, like Phoenix Labs treasury, is using Spark savings to do that. Good thing, I don't want to talk about a lot about Spark, but you could use USDC, you could use USDS, you could use USDT, and put your money on Spark and sleep without thinking about it. Right now it's 4.5.
Yeah, in my case, I would just use, I would think about the exposure I have rather than the yield. The yield will be dictated by the market, and the yields are changing based on, conditions around us. So I cannot predict what will be the yield, but I want to know what is my exposure, and I want to have exposure only to, let's say, blue chip assets with clear underlying, with clear liquidation engine, and things like that. So I just want to put my USDC into the place where I will not have exposure to, let's say, risky exotic assets. So I use Fluid for that. Yeah, and the market will dictate the yield.
I guess if I have to give a yield number, honestly, it's not necessarily determined by the yield. I would say it's determined by like the expected consistency of that yield. If I have a year of exposure, if someone said you can get 12% and it's consistent and there's no risk, that's obvious. But realistically, that's unrealistic. Like, frankly, Spark's 4.5%. That's pretty solid. I think I'd find opportunities, maybe get 5 to 6. But if you're seeing anything above that, advertising consistency, I think that's quite unrealistic. So I think everyone hit it on the head. It's really not about the yield number. It's about the underlying risk. It's about the consistency of that yield, especially if you're exposed for a year. So yeah, I'd probably say, I don't know, 5 to 6%.
Okay, so the reason I'm asking this question is in crypto, everyone has ADHD. And it's not our fault. It's how the industry is constructed, with CryptoCity claiming new yield opportunity over and over and all the time. So the question is, right, like, what is the satisfying yield that you just give up the opportunities that are over there and you do not FOMO, and you just keep consistently into one strategy for a year? I personally have done it with Spark, with the previous product, with SDAI when it launched. I did keep like a very long position on Fluid specifically, and I also kept like small position on Morpho in a managed vault by Gauntlet. But myself, many times I was tempted to potentially like move that asset to this new vault or new yield strategy or new farm, because there are so many. So that's not an easy like task to do. But switching gears a little bit, what is one biggest misconception you would like to clear about the protocol you're creating? So may it be Spark, Fluid, or any of the Gauntlet products. Is there something that you would like to emphasize that people get wrong about you?
Yeah, I mean, I think people generally put Gauntlet in a silo. I think people put Gauntlet in different silos, but overall someone has generally a singular perspective on what our company does. I would say the biggest misconception is Gauntlet is pretty active across every vertical in DeFi. Obviously, we have a pretty active vault curation team on Morpho, but we also have a lot of perp strategies. We do a ton of just research and mechanism design, et cetera. Report publishing. We work with DAOs. So I would say biggest misconception is just how broad Gauntlet is in terms of what we end up doing across the space.
DMH?
Yeah, the biggest misconception about Fluid, people often think that it's a lending market or it's a DEX. It's none of this. Fluid is a liquidity protocol. On top of liquidity protocol, we built many different protocols. It can be DEX, lending, which we have now, and there'll be many more protocols in the future. And then each protocol itself has a lot of complexities, a lot of innovations. Especially, I think the most misunderstood thing is how we can utilize debt from the lending market as a liquidity on the DEX, how we create this capital efficiency, how we became the second biggest DEX on Ethereum within 3 months, purely because efficiency, no incentives, no private LPs, and so on. Yeah, so it's a complex protocol. It takes time to understand it, and it doesn't take only 1 hour or 1 day to fully understand it.
For me, the most confusing was InstaDApp versus Fluid, but you already cleared it out, and I believe now Fluid is the token, Fluid is the protocol, and everything around it. Nadia?
I mean, it has been different misconceptions, but I think the latest one is that right now we are also Morpho curators, and probably a lot of people think, oh, okay, they're Morpho curators just like as Gauntlet is. I don't know. And I think that's a misconception because actually Spark is not just that one team of people like doing risk curation. It is, it's part of like a double DAO, if you could say. So we have like a very strong security parameters, and we are super, super, super conservative because whenever we onboard the new assets and whenever we like do risk assessments, it has to be approved by 2 different governance processes, the Spark governance and the Sky governance. In each of these 2 processes involve different risk teams. So just to give you an example, in the Spark governance process, we have a risk council composed by L2Bit, Aragon, and Blockworks. So we have not just Phoenix working on new proposals, but we also have a team of like very well recognized actors in the ecosystem analyzing what we are proposing. Everything is open. Community can give us their opinion, and then it has to pass through a vote for the Spark governance and the Sky governance. So I think that if people could understand that, they will automatically know that we are not like any other risk curator.
Yeah, I would say with big power comes big responsibility. That's the reason there is also so many layers for the governance over here. Carson, Gauntlet is one of the biggest, if not the biggest, vault curator right now on Morpho and other platforms. It's been, I believe, about 2 years since you've been doing that. What are the key learnings that you have so far and something you would like maybe to share with people, maybe especially with some recent blowups, like we've seen Stream Finance, Elixir going down. It is a hard job. I believe people underappreciate it. So any thoughts here?
Yeah, I think the biggest one is just maintaining a long-term view. I mean, Gauntlet has been around for 8 years now, doing lending risk management for long before we were active on Morpho. And so obviously there's a lot of short-term opportunities to juice yield maybe 50 to 100 bips. But the biggest thing is maintaining that long-term view and understanding is, making a decision now that might boost performance of a vault for a few months. Is it worth it if we think 3 years from now, 5 years from now, 10 years from now, is this really going to justify this action? I think for a long time, as long as you kind of center yourself in that long-term thinking, you can filter out a lot of kind of short-term opportunities. I think the other one is, and I think we're all still kind of figuring it out, and obviously you are too, but being able to communicate risk. I think that's one of the best things we have on the like within Morpho vaults is being able to tranche and assign risk. And I think we're seeing that really expand across a ton of different opportunities. But communicating that risk to the user is generally not straightforward. Obviously, you can like name a vault. You can represent some APY that people make a determination based on what that must mean for risk, which I think is generally what people do. People see like 10 plus high risk, sub 5 low risk, and that's generally like I think how most people make these determinations. So with risk ratings and with proper communication to the users, being able to make sure you're able to provide essentially a product that they want and make sure that they are really depositing it into exactly what they want and understand what they're kind of getting exposure to.
That's very interesting take that you said that people look at the APY and they assign risk to it. And I can tell you with RedStone, before acquiring Credora, we've done some in-field unofficial surveys. And usually people don't think that way. The way they think, they segregate the vault by TVL, so how much is deposited, and then they look at APY. So they strip away sort of like the risk component because they don't see it on the platform. They rather think about the social proof and what peers are doing. So if people already put a lot of money into a specific strategy and it has a good yield, that means they have already done the due diligence. So you kind of try to piggyback on some others people's decision before. So this is also where yes, so this is usually when, that's a funny sign over here. This is the reason we are bringing Credora in general. So essentially helping them to have a visualization of the risk on the platform so they have yield, risk, and amount of money deposited in one place so they take more informative decisions. Okay, DMH. Fluid has this advantage of having a DEX right now, right? Like being the liquidity layer. Aave doesn't have it, Compound doesn't have it, Morpho doesn't have it. Tell us, what's the actual biggest advantage of having it? Like, what's the superpower now?
So our lending market is powering our DEX, and our DEX is powering our lending market. So how our lending market is powering the DEX? Because we can utilize debt from the lending market as liquidity on the DEX. This creates a zero-cost opportunity for liquidity providers. Like our biggest DEX pool of USDC, it has around $130 million in liquidity, but it has $0 in TVL. So all of that liquidity is created out of debt from the lending market. At the same time, our DEX is improving our lending market because, for example, one of the features that we have and no other lending market in DeFi has, we have active liquidity crunch protection. So when, you know, like when Ethereum goes down in price, liquidators come liquidate the positions. And let's say for protocols that have a hypothecation, like Aave and Fluid, for example, normally the utilization of Ethereum is around 90%. But what happens when positions get liquidated? The utilization goes to 100%. And then liquidations cannot happen because there is no ETH left in the protocol. If there is no ETH left in the protocol, liquidators cannot come and liquidate it. They have to repay the debt and seize the collateral, but there is no collateral in the protocol left. But on Fluid, when Ethereum price goes down, you have the same thing, but on the DEX side, when Ethereum price goes down, Ethereum USDC DEX LP is getting more Ethereum. So more Ethereum is entering the liquidity layer from the DEX, and Ethereum is leaving the protocol on the lending market side. So in our case, we cannot get this liquidity crunch when liquidators cannot seize the collateral because it's absent in the protocol. That's already what we have. I mean, like the day we launched the DEX, we already got this active liquidity crunch protection. We can do more things like prioritize liquidations on our DEX. So there are more things that we can do, but we haven't done them yet. But even this liquidity crunch protection is already a big thing. The other big thing, of course, like users can use their DEX LP as a collateral, so they have better capital efficiency. They earn more yield, and yeah, and same like with smart debt, where they have lower borrowing costs. So for the borrowers, we always have the best conditions in the market because like they have higher yields on the collateral, lower borrowing rates on the debt side.
Is it fair to say that Compound, Aave, and those lending markets are a feedback loop with DEXs, for example, Uniswap and whatsoever, so they go back and forth? And what you're trying to create is more like a cycle in the sense that it still lives within the same ecosystem?
Yeah, so like how fluid, or the architecture fluid, there is a liquidity layer and every protocol contributes to the same liquidity layer and utilize the same liquidity layer. If I deposit to the lending market, I deposit to the liquidity layer. If I deposit to the DEX, I deposit to the liquidity layer. If I make USDC swap on the DEX, I deposit USDC, I withdraw USDT from the liquidity layer. Everything, like all liquidity is shared between every protocol, and there will be more protocols in the future.
Okay, beautiful. Thank you. Nadia, Spark also has a couple of products. One of them is Sparkland, but recently also launched Spark Saving V2, which happened to be pretty successful with filling the caps very quickly. Can you tell us what is the innovation with V2? And I will repeat, you keep your treasury there, right? Like Spark.
So the difference between V1 and V2, it is more like a UX improvement. So V1, it was all based in SUSDS. So in the back, we are using the Sky Savings rate. But the Sky Savings rate comes from the yield that we generate through the Spark liquidity layer, which is the capital allocator. That's the reason why Spark also manages Morphovault, for example. We are just like allocating liquidity in the best places with the risk adjusted for us. But the difference with Savings V2 is that we perceive the need that people have about, if I deposit USDC, I want to earn yield on USDC and I want to withdraw in USDC. So that's the thing that a Savings V2 provides. So right now we have 3 stablecoin vaults with USDC, USDT, and USDS, and 1 ETH vault. And I think like the things that I like the most about the Savings V2 is that you can deposit any of these assets and withdraw in any of these assets. We don't charge a fee. You don't have a slippage. You have access to liquidity at any point of time. Like there's not like there's not enough funds in the pool and you have to wait. That doesn't exist in savings. If I deposit 1 billion, I can withdraw 1 billion. So, and also something that is amazing, I believe, is like rates are what we call transparent. So it is the same rate if you deposit $100 or if you deposit 1 billion. We keep the same rate because of how Savings V2 works. And is how, well, the Spark liquidity layer works in the back. So yeah, I would say those are the main difference between V1 and V2.
Interesting. So I think it can be also, has the potential of becoming like a benchmark for like, let's say this low risk actually allocation that has a very simple UX for the user to interact with. People like bold predictions. Right now it's November in 2025, 1 year ahead. Imagine we meet again at Stable Summit, probably in Africa or maybe Asia at DEF CON, maybe in Warsaw. By the way, we are a big proponents of making it in Warsaw next year in Poland. What is one prediction you have or thing you would like to see in the lending category as we move forward, either in the vaults and permissionless markets or in the lending in general? Do you have any, Carson?
Yeah, I mean, I think in the next year, it's really going to be on upgrades on the protocol side. I mean, obviously, we've seen Aave started talking about Aave V4, Morpho starting to launch Morpho V2. DMH is talking about adding new protocols to Fluid. We're hearing all about Spark, Savings V2. So overall, I think it's really just updates to the biggest protocols in the lending space and how they add tighter granularity on risk preferences. I don't think there's going to be like some crazy killer use case that no one's thought about for lending. I think it's pretty straightforward. Maybe there's some collateral expansion and new types of assets coming on board. But overall, I think it's really going to be a lot of the big protocols making significant updates, trying to migrate capital over to their newest deployments, and seeing essentially how that transition plan is executed.
DMH?
I think for the next year, there will be few new features. I mean, at least few more narratives that lending markets will try to unlock. It's fixed rates and more RWA exposure. I think fixed rates is like one of the most important unlocks, and there are several ideas in the space how to unlock fixed rates. Even like we can say Spark has sort of fixed rates. It's not a fixed rate, it's rather than stable rate, rather than fixed. But yeah, I think like more and more protocols looking into fixed rates, how to achieve them, because whenever we speak with different institutions, they say, yeah, we want to use DeFi, but like we cannot accept floating rates. So yeah, I think many protocols will look into that, and then this will also unlock a lot of RWA assets in DeFi and on the lending markets especially.
Beautiful fixed rate, Nadia.
Yeah, so first of all, I support the Warsaw event, so yes. And so my prediction, I think, is more like on the, I don't know how to call it, but right now I'm seeing, like this year, we saw DeFi interacted with centralized exchanges, right? I believe that next year it will be DeFi interacting with banks, institutions, and also on the other way. I believe that banks, neobanks, and all of them are going to have rails in DeFi. They are going to integrate in DeFi. So we will have like these hybrid TradFi DeFi solutions, and I'm super excited about that.
Yeah, we see Stripe, Robinhood, Revolut, all of them experimenting with on-chain, and I do believe it's going to just proliferate. My bold take is that in 3, 4 maybe years, there is going to be no fintech company. All of them are going to be fintech and crypto company. Like they're going to do both of the rails. As we still have 3 minutes, I want to touch upon one subject that is interesting: insurance. That is essentially still, I would call it even non-existent almost in crypto and DeFi. I mean, of course, there's Nexus Mutual. There are a couple of protocols that are trying to offer some, but in comparison to traditional markets, there is very little choice and coverage. Do you believe we can see some innovation in insurance in the next years? And if so, what has to happen for the insurers, either crypto native, so Nexus Mutual, Symbiotic, Eigenlayer, or the traditional ones like Lloyd's of London and the big names in insurance to expand to lending and DeFi in general?
I mean, we've been having a lot of conversations around insurance. I think the answer is yes, there's certainly an appetite for insurance. I think it is kind of tough right now within the crypto space because generally insurance is expensive. You're not getting, and the market is so correlated and there's not a ton of diversity of options. Generally, you can't insure, let's say, like 20 different positions, get high capital efficiency, and have a high degree of confidence that they won't all blow up at the exact same time. And so I think it's really cracking this code on how do you introduce more diversity in the collateral set that introduces more capital efficiency into the insurance side. Because right now I think there's a lot of solutions that work, but are generally quite expensive and don't necessarily make sense for most users who would be looking for insurance. So huge appetite, but I think it needs to kind of figure out some efficiency there.
Yeah, so insurance is like very big in real world, but in DeFi, it's hard to use now because yeah, it's first of all, it's very expensive. You know, if you take insurance, even like for something like Alvarez, and you will pay the half of the yield, and then like, why would you deposit for 2%? Like, that doesn't make sense. And second thing, like I think many people are not sure like if insurance will pay off eventually. Maybe they need another insurance for this insurance company. So
there is the whole category called reinsurance, right? Like of insurance for insurance.
Yeah, and by the way, like, you know, we have Eigenlayer, which like has 19 billion TVL or something, and they have 0 use case, even though they like trying to do some reinsurance or something. So it's something that we need in space, but for the moment, I don't have a clear picture how it will be enabled and like what will be, you know, yeah, how it will work actually.
Okay, too expensive to implement essentially.
Yeah, I second the guys. The problem is that it's very expensive, it's not capital efficient, and like, I mean, DeFi is not capital efficient because we are all over collateralized, so we're already creating frictions there. So I think, yeah, there's something there, and it would be great if we could like, I mean, there's an opportunity for all the new builders there. We tried in a way to solve it through the capital we need to have in the Sparks treasury whenever we want to allocate. So that's like one of the efforts we're making, but I think there's more to be done. So yeah, I agree with the guys.
Beautiful. And maybe I'm going to finish that you can right now use prediction markets as some sort of insurance. For example, there is a market whether there is going to be a DeFi hack until the end of the year, and you can buy a yes. And then if it happens, you at least have the payout from the poly market, right? Thank you very much for the beautiful panel. Give a round of applause to the panelists.